Just making the top 10, Vedanta Resources. Shares surged 10% in one day last week as iron ore mines reopened in Goa, earning a buy rating from Alpha Value. HSBC faces billions of pounds worth of civil claims over forex rate rigging. It's in at number 9. The bank's shares have shed a little over 2% over the past year. Rio Tinto, which currently yields 5.4%, is the 8th most traded stock here at IG. The miner has increased cash flow per share at an annualised rate of 10.1% during the last 5 years. At number 7 is BARCLAYS. Last week it entered negotiations with the New York Attorney General and the US Securities and Exchange Commission over allegations the bank defrauded clients by lying about the extent of high-frequency trading taking place in its so-called dark pool trading venue. Just missing the top 5, BHP Billiton. Analysts at Liberum say cash flow over the next 12 months will fall well short of covering its dividend unless it can implement more drastic capital expenditure cuts or commodity prices rise. It's maintained its hold status on the stock but downgraded its target price to 11.25. Tullow Oil, which is due to return to profit this year and then more than treble its earnings next year, was the 5th most traded stock at IG last week. It said it plans to further deleverage the business and that gas production at its Jubilee field in Ghana has resumed ahead of schedule. At number 4, TESCO. The price wars between Britain's major operators continues to erode TESCO's traditional customer base. Shares are now just above 200 pence per share after an 11% share price decline during the past 3 months. BP is at number 3 as it fights against allegations of gas market rigging. Its share price has sunk 17% since the middle of May and 28% since the crude prices dived from $115 per barrel last summer. At number 2, Glencore, which is expected to post a 30% drop in profits this week. Its shares have fallen to a record low of 172 pence, quite some way from its 530 pence debut 4 years ago. But at number 1, another bank, Lloyds, as it continues to establish a newfound medium-term trend.
The Lloyds share price has really taken a turn for the worse over the last month or so. Now, what we can see is, despite the boost that we saw from the election, it's really been selling off. The creation of lower highs and lower lows is a warning sign. Now, what we're seeing in terms of the near term is that we've got this consolidation below this major 200-day SMA. Previous support, now it's turned into resistance. This looks like a flag to me, which is a bearish continuation pattern. On the 4-hour, we can see price action is closely tracking below this 20-period SMA as newfound resistance, and therefore I do expect further losses, and I do expect us to move back down towards this 77 mark in the near future.